Well, hello, everyone. Welcome back to Finance Friday on the ARCUK YouTube network. I hope you're all happy and well today. I'm Hard Money Jim, speaking from winter quarters in Coronado, California. It's the home of the United States Navy SEALs Basic Training Program. So let me share my screen here, and you can get a look at some of these guys. This photo was taken just a few hundred yards from my house, where every few months a new class of SEAL recruits undergoes what's called BUDS training. That's BUD/S, which stands for Basic Underwater Demolition SEAL. And it's one of the most challenging military training courses in existence. The candidates are all very highly qualified just when they come in, but the course is so rigorous that only about half of them make it through a typical 6-month training class. We are very proud of the SEALs in this neighborhood, and we're glad they choose to train with us and live with us in Coronado. Okay, today is part 2 of a 3-part series. Part 1 was titled Uncle Sam's Unpayable Debt, in which I argued that the U.S. government debt has grown so big and its future obligations so extensive and open-ended that the total debt cannot be repaid in today's dollars. That is, at today's purchasing power. Now, we wish our monetary authorities were as rigorous in their spending as our special ops soldiers are in their training. Our politicians' only natural response to their self-imposed debt problem is, I think, going to be something called financial repression, which is a combination of high consumer inflation, I should say, characterized by high nominal GDP growth, coupled with a forceful suppression of interest rates to a level below the level of increase in the consumer price index. So high inflation, below inflationary interest rates, and negative interest rates. This is what many economists call financial repression. And today I want to take up part 2 of the series, which I'm titling Financial Repression, the Disease and the Cure. So what actions will the various government and financial institutions take as they try to alleviate the debt burden that they've imposed? You know, what's the Fed going to do? What are the commercial banks going to do? What are the financial regulators and Congress going to do? Money creation is going to be likely at the heart of their response to our overwhelming debt. And the theme today is that just as money creation in the hands of government is a significant cause of our debt problems, money creation will also be the government's proposed solution to those same problems. Our monetary institutions, the Fed, the banks, the Congress, regulators, and so forth, will implement policies designed to reduce the government's debt burden relative to GDP and relative to tax revenue. So the main question is today is what laws, orders, policies, and so forth will our politicians and financial authorities invent to implement financial repression? Now, addressing that question will then prepare us for part 3 of this series, titled Surviving and Prospering Under Financial Repression, in which I'll make some suggestions on what we can do to avoid being victims of, avoid being financial victims. So next time we're going to ask, how does financial repression change the investment landscape, and can we take advantage of it? In general, how should we be thinking about investing for the next 5 to 10 years under financial repression? So the third session, which is 2 weeks from today, will hopefully be your payoff for the time you've invested into understanding money creation and its consequences. So that's our trajectory for today and for next time. However, before I get into part 2, I really need to address a good question that came from a Sharp subscriber. And this is from Tom. Tom says, I feel like I've been hearing about the train wreck coming from US debt for at least 30 years. I think about Ross Perot as an example, emphasizing it. Eventually, it seems like the math dictates that the wreck comes, but understanding the timing of it is critical to investment decisions. How close are we to the wreck? If you had to give an inside date and an outside date, what would they be? Now, I did not adequately answer this point last time, so I want to take it up today, and it may take a few minutes, so please bear with me. Let me first, in doing that, make a general point that I should have made in part one. When a government cannot pay its debts, what are its options? The range of government's possible responses can be sort of broken down as follows. One, hyperinflation. Option one, hyperinflation. Government can pay off debts with made-up depreciated currency. This was like Weimar Germany and Zimbabwe as prime examples. Under this scenario, the economy collapses and everyone suffers. The government might survive, but out come the mobs usually with pitchforks and torches. This is usually an inferior outcome for the people in power. Now, although some pundits are predicting hyperinflation here in the USA, I disagree. I do not think hyperinflation is our fate, as I'll explain shortly. Okay, option two, when you can't pay your debts, outright default. A government just reneges on its promises. The government just admits they can't pay. They say, oops, either we or our previous government, overpromised, and now we confess we simply cannot pay off all our debts. So we'll cut Medicare way back and eliminate Social Security, but you still have to keep, paying the payroll tax. And you can see this would be so unpopular as to be foolhardy. I think it would anyway. This option also evokes the world of, pitchforks and torches. Now, default is true. It's true. It's more honest than hyperinflation, but it's such a poor outcome for the people in power. I think it's unlikely. Okay, option three. How do you pay off your debts? Option three, it's what some economists call austerity, in which the government raises taxes severely and defaults selectively on its sort of less urgent promises, like maybe its foreign held debt. But basically, you limit your budget to tax revenues. But that means you have to cut services that are being funded by your borrowing. So you risk miscalculating about which promises you can break and which ones you can keep. Austerity is kind of a bitter pill for the population, and it's politically dangerous for the politicians. So I believe it's unlikely to be the solution for our debt problem. And now option four, smoke and mirrors. Smoke and mirrors. You pay off the debts in a depreciating currency while artificially holding your finance costs down. And this is recovery by fooling most of the people some of the time. The most favored version of smoke and mirrors is financial repression, because financial repression spreads the pain through inflation. So it taxes silently by keeping interest rates below the inflation rate. It's the least painful policy of choice when government is dealing with unmanageable public debt. So that's why I think it's the odds-on favorite. Now let's go back and look at the politician's cash flow problem. The government needs cash inflow to finance an expanding spending program. Now, I concluded last time that government payouts can't be cut back in nominal terms, or the politicians will lose their jobs. And because taxes are limited by the size of the economy, I concluded that growth in tax revenue is limited by GDP growth. Then, as debt grows and interest costs rise, the ability to borrow becomes limited by ballooning interest payments. So the government is stuck in a debt trap where additional borrowing is constrained by rising interest costs. And so again, I want to, Tom asked, how close are we to the train wreck? it does seem inevitable that rising U.S. debt will become an existential problem. In fact, it is. But this has been going on for a long time. That's what's been going on for a long time. These high interest costs have been seen as a problem. And yet everything still seems to function. So Tom has seen this movie before, and he wants to know when the end game is coming and what is that end game. So let's go back a few decades to the 1980s and see what Tom was talking about. The chart here shows government interest expense as a percentage of GDP. You can see in the 1980s, it's the highest it's ever been, way up in the 5.5% range, 5% range, I should say. At 5% of GDP, that meant that interest costs were eating up 25 to 30% of all government revenue. We had seen big deficits before to pay for wars, but now we were borrowing and incurring significant peacetime deficits. Moreover, we were borrowing just to pay the high interest costs because interest rates in the 1980s were in the 15% range and higher. Now, by 1990, right in here, interest rates had fallen to 8%, but and that's still historically high, but old debt being rolled over, even at that rate, was still keeping the total interest burden high until interest rates really started declining in around the early 1990s. But with interest rates that high back in the 80s, we were already at a point where interest rates were a key factor in the politician's cash flow equation. High deficits are financed, by borrowing, some of which is monetized, which means that the debt is transformed into new money. This additional new money is inflationary, and eventually it drives prices higher, which requires higher interest rates, which raises the government's interest costs, which leads to higher deficits to pay for those interest costs, which means still higher interest costs in this vicious circle of higher interest and expanding debt. So that's what people are afraid of now, and that's what people were afraid of then. The deficit looked bad then, and it attracted a lot of political attention. And that's the historical period that Tom is talking about in his question. So the political result of this very widespread concern with the debt in the 1980s was this guy, Ross Perot. He was a Texas entrepreneur who self-financed an independent third-party run for president. Based mostly on concerns about the deficit, Perot was able to get an 18.6% share of the popular vote in the 1992 presidential election. I think that's astounding. He split the Republican Party in doing that, and the result was that a Democrat, Bill Clinton, got elected. Bill Clinton ended up being more serious than we ever would have thought about deficits. Excessive government spending was such a big concern at the time that even Bill Clinton, a Democrat, said it was time to, quote, end welfare as we know it. This was presumably driven by a genuine realization on his part that there is a limit to other people's money, just like Margaret Thatcher had warned. Now, just to illustrate the importance that the voters put and politicians put in the federal debt issue, President Clinton then cooperated with the majority Republican Congress and actually balanced the federal budget right up in here in the late 90s, 2000. You got a small budget surplus, actually, of $21 billion. Now, I give all credit to Bill Clinton and the Republican Congress for this very unusual, positive, bipartisan achievement. However, as you see, the surplus didn't last long, and the deficits resumed in the early 2000s and began a gradually cyclical increasing trend. What enabled the budget surplus in the late 1990s was a combination of three factors. First, a continued decline in interest rates. I mean, we were in a 40-year unprecedented bull market in bonds that eventually culminated in the lowest interest rates recorded in 5,000 years. Look at the drop right here between 1990 and 2000, which culminated here around 2000 in the budget surplus. The second factor enabling the budget surplus was that government spending grew slower than GDP. So again, look between 1990 and 2000. Federal net outlays as a percentage of gross domestic product are declining. And they declined from 21.5% of GDP to 17.5%, even while GDP itself was growing very nicely. Okay, and finally, the third factor was that for achieving this surplus was that government revenues as a percent of GDP were high and rising. You can see here, 1990 to 2000. So by 2000, tax revenue was pretty much maxed out at its upper bound of 20% of GDP. So with a combination of just a little fiscal discipline, a strong economy with rising tax revenue, and a rapidly declining interest rate, they managed to balance the budget for a couple of years. But in the early 2000s, fiscal discipline started evaporating. Notice that from 2000 here to 2010, both the total debt, which is the blue line, and the debt relative to GDP were increasing as the deficit was accumulating. However, back to this chart, declining interest rates allowed the interest burden as a percent of GDP to stay pretty constant after 2000. See, from 2000, it's kind of meanders sideways here. Because of rapidly declining interest rates, by the time we got to the early 2000s, interest cost as a percent of GDP had dropped back to 2.5% of GDP. That was about 13% of total government outlays. So it was no longer an immediate problem. Interest was no longer a problem. So it was just like repeatedly financing your home for more money at lower and lower interest rates. And many people did just that during the declining interest rates and housing bull market of the early 2000s. They pulled lots of cash out of their house as it appreciated in price. In a similar way, and for a while, declining interest rates created an ATM machine for the big spenders in government. And so much so that in the early 2000s, right after the dot-com crash, the deficits came back to stay. But the politicians no longer cared. As I mentioned last time, it was in 2003 that Dick Cheney famously remarked, quote, "Reagan taught us that deficits don't matter." Now, I hope you're noticing that the big spenders and borrowers come from both sides of the political aisle. There were very few heroes in this deficit story. Ironically, Bill Clinton being one of the few, and that was only for a short time. There was, though, some plausible justification for Cheney's statement that deficits don't matter. The deficit was not a problem yet. From 2000 to 2010, this period again, total debt was rising, but as a percentage of growing GDP, it was rising slowly. And it was only 60% at the start of the great financial crisis, which is this recessionary shaded area right here. And even when the 2009 financial crisis hit and the Fed responded with massive borrowing and quantitative easing, the ballooning debt still did not seem to matter. Why? Because interest rates kept declining. Eventually, this long period of declining rates allowed debt as a percent of GDP to climb really rapidly topping at over 125% of GDP up here. Its current level is about 120%. This was due to declining. This peak was due to declining, quickly plummeting GDP, which subsequently recovered, which is why you get the spike here. All right, but even then, government borrowing was not yet, even here, government borrowing was not yet encumbered by interest costs because interest rates are still falling. And they continued this downward path to near zero during the pandemic. I mean, just think about it. If interest rates are permanently at zero, there's no limit to what you can borrow, is there? Right? Doesn't matter. But then came the pandemic-related, financial panic of 2020, and then we got unprecedented monetary stimulus, which gave us something we had not seen in a long time, a big spike in consumer price inflation. And with that inflation came the Fed tightening and much higher interest rates. So the blue line here is the effective interest rate, paid by the US government on its debt. As you see, it continues to decline. The red line is the 2-year Treasury debt, which is a good proxy for, the blue line, the red line is the 2-year Treasury yield, the interest rate on the market interest rate on the 2-year Treasury note. And as you can see, it reached near zero. And it's a good proxy for the average rate that the government pays as it rolls over its existing debt. So you can see here with this spiking red line that US government interest costs are set to double in a very short time. Now, this is the trajectory of those interest costs, kind of over the short term. By the end of this year, as treasuries mature and are refinanced at higher rates, the annual run rate of interest costs are going to be $1 trillion per year, or about 20% of tax revenues, and still climbing. Now, as I mentioned last time, the Congressional Budget Office projects interest costs to be over 11% of government revenues, which would be nearly 60% of GDP. That's interest costs, 60% of GDP. I'm sorry, 60% of revenues. That's not interest costs would be 60% of revenues by the year 2050. Now that's 27 years from now. But the CBO has typically underestimated deficits, so we could easily reach those levels sooner. I think long before we get to 2050, the bond market is going to want much better interest coverage than that, or it will want higher interest rates to be compensated for the growing risk. So today, the US government's ability to borrow is once again constrained by high and rising interest costs, just as they were in the 1980s. But there are several important differences between funding conditions now and funding conditions in the 1990s, when the debt concerns ultimately proved to be a false alarm. So now, at long last, we're getting closer to answering Tom's question. So what are the differences between then and now? The first difference is that because of consumer price inflation, interest rates are rising, not falling, and the likely trend of rates is set to radically increase interest costs. So as we've seen, interest costs will probably rise dramatically, and that's not in our favor. The second difference between now and the 90s is that debt to GDP is now 120% of GDP, as opposed to the 50 or 60% back then. The importance of that ratio is not its absolute number, but its absolute level, but in how it affects the total interest burden, the total interest cost, which always has to be paid. And because the higher debt level, the amount of debt out there, is a major determinant of the total interest burden, it means that even if interest rates stay at current levels, we're going to quickly run out of capacity to add additional interest costs when we borrow more. And finally, there is another very important difference between the 1990s and now. Unlike in the 1990s and early 2000s, today, the traditional buyers of US debt are becoming scarcer. They're becoming more endangered. So we have to ask the question, who besides the Fed is going to continue buying US debt? And how will we know if they're going to stop? Now, if your lender was a banker, he might say that if your interest cost as a percentage of your income were above, say, 20%, he would not renew your loan. And that might even be a provision in your loan contract. So you would know your borrowing limit. But the bond market has no such published rules, but it does have a limit on how much it will lend. The thing is, no one knows what that limit is because the limit varies among the various bond buyers. So as US creditworthiness deteriorates, the buyers start to incrementally drop out of the lending market unless they're compensated by higher interest rates. So our debt problem will become more acute whenever an important bond buyer refuses to purchase incremental debt. So what you see in practice is signs of this is a temporarily poor market for bonds and spiking interest rates, which the central bank then takes care of temporarily through QE. A recent example was the UK pension liquidity crisis, in which the Bank of England solved last September. So the central bank steps in, then it's back to business as usual for a while until the next stressful incident. Lather, rinse, repeat until something breaks. So I think what we're going to see is that the frequency and intensity of these little bond market brush fires gradually increases as we flirt with insolvency. But I think it's probably a gradually developing problem that results not in an explosion, but more like a spreading forest fire. So I don't think we're going to get to the point of true insolvency because all these warning signs are noticed by politicians who then will implement financial repression in response. So they see these dangerous little credit fires and they act. If they see some funding markets closing, they're going to try to open other funding markets, perhaps even by force. If they see interest costs going too high, they will try to suppress interest rates. The harder the funding conditions become, the more resourceful the government will be to find more money to keep their spending going. So I hope you understand why I think there's not going to be a monetary explosion or a debt bomb or one particular emergency or incident that changes our money and banking system overnight. More likely, we're going to see an evolution based on a pattern. That you'll see a problem followed by a response that is sort of a patchwork solution, then another problem, another response, etc., until we gradually evolve into a new monetary order that's going to change so slowly that it'll only look different from a historical perspective. So it's not as if financial repression will ever be an official or well-planned solution implemented by the government. I'll be surprised if you ever hear the words financial repression uttered by a career politician. But it is a system that will evolve as politicians search for ways to fund their spending. So the question I'm now asking is, if you want to follow the gradual process of credit deterioration and the political response to it, what kinds of these little brush fires can you look for that provide a warning about funding problems to the US market? We have some great recent examples of these little brush fires. So like, for example, in 2019, we had the repurchase agreement, the repo scare, in which the Fed had to rush in and provide liquidity to save the hedge funds. You might not have heard much about that, but the Fed now provides nearly all the money for money market funds through its reverse repo facility. And then we had in 2020 the financial meltdown, which is a major panic in the financial markets that the Fed addressed by an unprecedented massive money creation. It was very big in the financial markets, but it happened so fast that it didn't get a lot of public press like the 2009 crisis did. Then we had, as another example, the UK pension fund scare that was temporarily cured by market intervention by the Bank of England and its promises of an unlimited QE. Now, that's all recent, but where else can we look in the immediate future for other little brush fires? Well, let's look at what's going on in the Japanese bond market of all places. This excellent chart from Bianco Research illustrates the problem. The U.S. government's borrowing needs are skyrocketing, but who is lending and who is buying? That is who's buying treasuries, who's lending to us. The red line here is Asian buyers dropping off. And that is well known to be almost entirely Japanese and Chinese institutions, the majority being Japanese. Their holdings are dropping fast, as you can see, even as the Fed has been by far the biggest buyer of treasuries since 2019. And that's the that's the vertical line here, the blue line, which is also now rolling over as quantitative tightening has been implemented. So who is going to fund the U.S. government, the U.S. Treasury market? Now, while all this is going on, consumer price inflation and interest rates are rising in Japan. And the Bank of Japan has been buying unlimited amounts of Japanese government bonds to hold down interest rates. But this has caused their exchange rate of the yen to nosedive. So the Bank of Japan has been selling dollar-denominated investments, that is treasuries, to purchase yen-based investments to support the dollar-yen exchange ratio. But there's a lot of evidence that Japan may not be able to suppress bond yields much longer. CPI inflation is running at 3 to 4%, the highest in many, many decades, while the Bank of Japan tries to hold their 10-year bond yield down to 50 basis points, which is 0.5%, which seems impossible. Now, I'm pointing this out because a seemingly obscure problem could have great ramifications. I want to partially quote Jim Grant, one of probably the most famous financial journalists alive, on the risk that this Japanese situation presents to U.S. financial markets. Quote, and you can read the whole article in Zero Hedge, January 17th. Quote, I think Japan is perhaps the most important risk in the world. The risk is this: every business day, the Bank of Japan is spending tens of billions of dollars worth of yen to enforce Governor Kuroda's yield curve interest rate suppression program. To put this into perspective, in the UK, when the little crisis over liability-driven pension investing in late September happened, the Bank of England spent around $5 billion. The Bank of Japan does that before breakfast. Governor Kuroda, whose term is up April 8th, insists that yield curve control is here to stay. But is it? What will his successor do? The Japanese have an immense amount of net savings, and some $3 trillion of Japanese assets are invested in non-Japanese markets, of which half are domiciled in the United States. What is going to happen if suddenly Japanese yen-denominated rates become rather attractive? Well, a lot of this money may be repatriated, and the result of that repatriation will be a rise in volatility in markets we can't really identify now. I think the time is getting ripe for a big change in Japanese rate structures and therefore in interest rates worldwide. So if interest rates finally rise in Japan and the Japanese investors sell their U.S. investments to buy Japanese investments, this will put downward pressure on the U.S. dollar and dollar-denominated assets, and upward pressure on U.S. yields. The first visible evidence of this would be volatility in the bond market. In other words, Japan's condition might cause yet another brush fire, and maybe a big one, but you're not going to see it until it's erupted. You're not going to see it coming. There are other places to look for these little fires. Just to give you an idea of the kind of things you can look for. As I pointed out in a Substack back in April of last year called Banks and the Dollar, Government's New Favorite Weapons, there's pressure on many countries to find alternatives to the US dollar for international trade. You know, Russia, China, Saudi Arabia, and other countries would love to not be tied to the dollar as a reserve currency. Recent evidence of this is that China and Saudi Arabia are working towards a deal to buy oil for yuan, not dollars. And that means the Saudis are going to have to reciprocate their trade with yuan, using yuan to buy Chinese products. And then the two countries would settle their short-term trade imbalances, they propose, in gold. So we're talking here about a proposal for a gold-backed petro yuan. The Chinese interest in this is pretty obvious, but the Saudis now see an advantage as well. This kind of development, I think, helps to explain why central banks are currently buying unprecedented amounts of gold instead of US treasuries to use as bank reserves. So the question keeps coming up. Who's going to continue to buy treasuries as the dollar's status as a reserve currency weakens? All right. It took a long time, but we're finally in a position to answer Tom's question. So when will we know that the tax borrow spend system is about to fail, that the end is nigh? Well, the bad news is, I'm sorry to say, you won't know because the system will not really fail. As problems arise, politicians are going to adjust to keep the funding system going in an incremental way. But the good news is there will probably not be a single catastrophic failure of the US currency or a breakdown in government functioning because our funding suddenly dries up. It won't dry up suddenly because the sources of funding will change. So you don't have to, Tom, you don't have to, I don't think, precisely time anything, and you couldn't do it anyway. You can basically jump off this ship anytime now as it sails into rougher and rougher waters. Now, in my opinion, the sooner you get into your personal sailboat and go your own way, the better. But I don't think there's any specific point of failure that says you have to abandon ship now. And it might be a long time from now. So I hope, Tom, you're happy with that long answer. I hope it was thinking about it was helpful to me. And I hope you understand why I could not give you a date or a range of dates within which you have to act. I just don't think this is that kind of problem. Okay, well, that was pretty long. We still have some more to go, but let's pause here and see if there's any questions or comments.
We have a couple of super chats. First one is from Free Trade. Thank you so much for 100 Swedish krona. He asks, a system where the government borrows a currency it itself controls is inherently corrupt, no? Aren't bond buyers going to figure this out at some point and stop buying bonds?
First answer is yes, that's inherently corrupt. I mean, it's obviously inflationary, but see, that's the thing. It's not obvious to everyone. You get it, and but not everyone will. The mass users will not. And so the second part of the question was, what? Say that again, Daniel. The second part of the question.
Aren't bond buyers going to figure this out at some point and stop buying bonds?
I think so. I think what they'll do is they'll figure it out, as I alluded, bit by bit, incrementally. You know, so many are dependent on treasury debt as a hold of safekeeping. So the buyers drop off incrementally, one by one by one. That puts pressure on the bond market. That starts little brush fires and little credit fires here and there. And so the government has to go to different sourcing, which I'm now going to get into what they're going to do. So that's a great question, and you're right.
Another super chat from Apollo Zeus. Thank you for £5. He asks, is the principle of financial repression applicable to psychological repression?
I would say it's related in that the victims of financial repression are mainly middle class, productive middle class, traditional, the biggest victims, productive middle class, traditional savers. And when they find themselves up against a wall where they're working harder and saving less, and their standard of living is declining, it takes a psychological toll. So I think, yes, there is a relationship there.
And we also have a non-super chat question. What would happen if the US defaults on its debt?
Well, they defaulted to Russia. So when you have foreign holders of debt, you can get away with it for a while and get away with it sort of, on a one-off basis, sort of one by one. But if we default on, actually don't pay on, issues, treasury issues that are owned by many, many different kinds of people, I almost think that's unthinkable. I think it's not going to happen. I think we can always print the money to pay. The Fed can always print the money to pay and keep us afloat. And seeing the panic that would induce in the market, then the Congress will act. I'm convinced of this. They don't want to lose their jobs.
Those are all the questions so far.
Okay, good, great questions. All right, so I want to pause now and be sure that we understand why money creation is at the center of this discussion on unpayable debt. Now, I said money creation is both the disease and the cure. Why is it the disease? It's because government's ability to control the amount of money created and control who gets that new money is the very thing that enables them to take on so much debt in the first place. So look at what central banks are doing all over the world. Central bankers claim that they manipulate the money supply to control interest rates. And they do this in the service of maintaining healthy economies. But what they really accomplish by monetizing government debt and suppressing interest rates is to allow governments to spend beyond the limits that would be allowed if honest taxation was their only long-term source of funds. That's the problem Maggie Thatcher spoke of. The problem with socialism is you eventually run out of other people's money. Other people's money is easy to identify if you're just taxing them too much. But if you, the government, can create new money, you can always claim you didn't steal that money from anybody. There's no specific visible victim, so it's easier to remain unaccountable. Never mind that you took wealth from everyone in order to spend it on those who help you stay in power. They get away with it because it's really hard to detect and it's not well understood. So by analogy, it's as if you were a dairy farmer who keeps a big tank of milk on the farm, right? Every night your neighbor comes over, let's say, when you're not looking, and he helps himself to some of the milk, but he replaces the volume with water. Everything he steals, he replaces with water. Now, you might not detect that for a long time because the milk looks the same and might even taste the same after he's diluted it. You only notice it when people start becoming unhealthy because of the reduced nutritional content of the milk that you're selling. So I hope you see that until we understand money creation, we're never going to move the government and the Fed towards sounder monetary policies. Only voters can move the government in a nonviolent direction. So until we understand money creation, we can never get them to stop their destructive spending and debt programs. They're getting away with it not because they're getting away with it because not enough of us understand what they're doing. Okay, call that my soapbox motivation for understanding money creation and its consequences. Now, finally, I want to turn to the title of today's podcast, Money Creation, the Disease and the Cure. Now, as I just described, money creation is the disease because it's the thing that makes our politicians spending and borrowing abuses possible. But what may be surprising is that money creation is going to be the government's proposed cure for the problems they cause by the spending beyond their means. Okay, we got 15 minutes and I think I can do this. So the question is, let's talk about how money creation can be used to implement financial repression. So the question before the House is, what should we expect the government, the Congress, the President, the Treasury, and the Fed to do about our worsening debt dilemma? Now, there's several reasons that financial repression is attractive to politicians. First, it's easy to implement through existing money-creating institutions that the government already controls, such as the banks and the Fed and the financial regulators. And second, politicians are pretty confident their voters will accept it because the pain inflicted is gradual and the voters won't understand it, allowing the politicians to remain mostly unaccountable. Financial repression is also convenient for politicians because it can be implemented gradually, year by year, as the little funding fires flare up. This gradual pattern coincides nicely with Congress's short-term cash flow model. So imagine that every year there's a little problem, a small brush fire that makes funding the government in the traditional way a little more difficult. But every year Congress meets and they enact some new policy or law that keeps their money flowing. In their world, in politicians' world, a series of short-term problems can be dealt with by a series of short-term solutions. This is another reason financial repression will go unnoticed by most people. It's evolutionary rather than revolutionary. Now, I have said the government has to inflate GDP while suppressing interest rates. So let's take each of those two items in turn. First, how can the government make nominal GDP grow faster? Recall, GDP is a proxy for total aggregate spending in the economy. Higher GDP means higher nominal profits and higher incomes, which garners higher taxes. And as I detailed in a June 17th, 2022 podcast titled, "Why Did Inflation Take So Long to Show Up?" The Fed throwing money at the financial markets under QE raised asset prices, but it did not produce much in the way of consumer price inflation and high growing GDP until we got to pandemic QE, which stimulated the consumer directly. The Fed's QE did not get money into GDP producing activities until the pandemic QE. So the new policy has to be get money into GDP producing activities. Consumer spending and business investment are most of GDP, so that's where the money has to be directed. Now, how can the politicians accomplish this? First, helicopter money. I mean, direct stimulus to the consumer and businesses is an option, but it's not a good one because it's not productive in any way, and it causes very high consumer price inflation, which is, political suicide, at the same time discouraging people from working, and that's what we saw during the pandemic. A better option than helicopter money is credit creation directed at specific industries that the government wants to grow. Now, you can do this through the banking sector in several ways. First, you can kind of nudge the banks to lend to your favorite target industries. One way is through loan guarantees, in which the Congress would authorize Treasury to guarantee industrial loans, say, to green industries like solar panels and carbon capture. So the banks will cooperate as long as they're making a profit. So if their profits is guaranteed, banks will make these loans. Now, consider the advantages to the government of a guaranteed loan program like this. First, the government can get the banks, not the taxpayers, to finance its pet projects. It only takes 5 or 10% in reserve to guarantee even a lousy loan program. So it costs the government almost nothing to guarantee a sweetheart loan program. And the loan does not show up on the government's budget except as a small contingent liability. So banks, not government, create the new money to finance the government's latest boondoggle. This kind of central industrial planning is easy to implement under the existing regulatory structure, and it creates money that finds its way almost immediately into the taxable economy. Now, I might add that guaranteed loans are already an important part of the bank's lending portfolios here in the USA, but even more, especially in other countries like the UK. The economist Russell Napier has reported that that there's a guaranteed lending program in place to support shipbuilding in the UK. And guess what? Shipbuilders are getting their capital. In the USA, guaranteed loans were implemented as part of the CARES Act in 2020. That was the first pandemic stimulus program. And I think we're likely to see much more of this as it's needed. Another way to jack up GDP is to prevent it from shrinking if big business or industries get into trouble. So the Fed can intervene directly in important businesses that are failing by lending directly to them or purchasing their debt or backstopping the bank's lending to them. For example, if American Airlines gets into trouble, you can bet they will not be allowed to go bankrupt. And the regulators can also encourage increased bank purchases of government debt. Right now, banks are limited in the bonds the government bonds they can own due to a requirement to hold a minimum amount of capital against government bonds. That could be waived, opening up a large new source of demand. I mean, that's what Argentina did. So the banks might join the Fed by becoming even bigger buyers in the government bond market. Regulators could also change the accounting rules, the mark-to-market rules on government bonds, so that as interest rates rise, banks don't have to take a loss through their profit and loss statement. This kind of thing has been done before selectively in other crises. Oh yeah, sorry, this is what I want. There are other things government can do. For example, if you want inflation, but you don't want the optics of high inflation numbers, just change the way inflation is measured to make things look better than they are. This takes pressure off the Fed, which could then pretend to not raise its inflation targets and allow the Fed to reduce interest rates sooner while still retaining some credibility. Or regulators could just encourage forbearance in the bank on bad bank loans. Just say, don't foreclose. This is known as extend and pretend. And this policy prevents the money supply from shrinking because it prevents outright loan defaults. So there are all kind of ways to create more money and get it into GDP enhancing activities. And if it sounds like a command and control banking system, then congratulations, you've been paying attention. That's a little too soon for Russell there. All right, so what about the other side of financial repression, suppressing interest rates, specifically keeping interest rates below the level of consumer price inflation? Now here it's clear the government's going to have to require or encourage large institutional bond buyers to purchase its bonds at below market interest rates. And if they have to buy your bonds, and you don't allow them to invest in other high yielding alternatives, you can suppress interest rates, essentially by force. So as mentioned, the Fed could require or encourage the banks to buy more treasuries by relaxing solvency and capital rules. Congress could encourage state and municipal authorities to buy more treasuries by changing fiduciary requirements. For example, you could require that state pension plans own more long-term treasuries in order to qualify for federal aid. And they would justify this in the name of, financial safety. Congress could encourage or require private savings institutions to do the same. Insurance companies and private pension funds could be forced to hold more treasuries in the name of financial safety. And here too, relaxation of certain accounting rules could make holding treasuries more attractive. We could see programs to encourage direct investments in treasuries by the public. For example, Japan's national debt is mostly held by private household savers, and it has been for years despite very low rates. Now, I imagine if we see a central bank digital currency from the Fed, they'll make this easy, and they might even make it mandatory to, quote, invest your central bank digital currency into U.S. Treasury debt. And then let's not forget standard interest rate suppression by the Fed. I suspect is you're going to see the Fed implement a technique called yield curve control, in which, like the Bank of Japan, they suppress long-term interest rates to help decrease government's interest costs. And then there's something called capital controls. As the real interest rate in the home country is suppressed, investors are going to want to venture abroad for better returns. And so the government will need to make that difficult to keep the money at home, invested in low-yielding government debt. So they'll institute capital controls designed to discourage investment outside the USA. They can do that through the tax system. They won't make it impossible, but they will make it more difficult for the average saver and investor. Now, if all this sounds like a soft takeover of the financial system, especially of the banking system by the government, I think you have it right. What used to be known as, quote, commercial banks will increasingly become financial utilities in the service of the government. We know this policy can work to reduce the government debt burden. This policy I'm describing can work because it has worked in the past. Even though it exacts a very nasty toll on ordinary citizens. This economist, Russell Napier, chronicles the post-World War II history of France and Britain, which had very high debt to GDP ratios because of their war debts. And they were able to radically reverse debt to GDP in about 15 years by eliminating the kinds of policies I've been talking about here. Okay. To summarize, what happens is that under financial repression is that nominal GDP grows, and along with it grow tax receipts. Interest rates are suppressed, removing the burden of growing interest costs, and gradually debt as a percentage of GDP declines, and then the ability to borrow heavily is once again restored. It's a pretty obtuse way of paying off existing debts in depreciating dollars. It's really a variation on the same trick governments have used since the time of the Roman Emperor Hadrian, when he actually, shaved the edges off silver coins and kept the bullion. So the next thing we should consider is how to react to this, and that is how to survive and prosper, perhaps, as this financial repression continues to develop. Okay, but that is part 3. So let's draw a line for this week, and we'll continue the discussion on what you can do to defend yourself next time. Wow, that took a long time. Do we have time for a question or two, Daniel?
We have no questions, but thank you, Dwayne, for your $5.
Yes, thank you, Dwayne. All right. Well, you talk about hitting, I got 11:59, or my time was 11:59. So thanks everybody for listening, and I will see you again in a couple of weeks, and hopefully it'll be the payoff for you paying attention as you have. I wanted to show you this. You thought egg prices were too high. Here's an early Easter present. Check me out on Substack, and subscriptions are free, and I will post this on Substack in a few minutes. Thanks, everybody. Have a good weekend.